Hi, everyone. Thank you for joining Professor Siegel on the Markets, where you'll hear from Professor Jeremy Siegel, Wisdom Tree Senior Economist, Jeremy Schwartz, our Global Chief Investment Officer, and Kevin Flanagan, our Head of Fixed Income Strategy.
Well, thank you everyone for dialing in. Professor, thanks for making yourself available. I know your phone has been busy since your 7 a.m. appearance on CNBC. The professor, as you all know, has not been shy in sharing his critiques of the Fed when he first saw the inflation early on in May of 2020 to now as he sees inflation a different story with some very big, bold calls. We're going to get his take on what he sees. Kevin and I will try to share some ideas on portfolio construction, where to be positioned. We've got a lot of questions submitted. We're trying to get to as many as we can, but we've about 30 minutes. Professor, the floor is yours. Give us your latest thoughts.
Thank you, Jeremy. Let me try to make clear exactly what I was saying this morning. I had given it a lot of thought over the weekend, particularly after the Friday labor report. So let me just lay down the basic facts, and they're very simple and straightforward. Every quarter, the Federal Reserve gives its long-term estimates of what it thinks the unemployment rate should be, what it thinks the Fed funds rate should be, what it thinks inflation should be. Now, that's always at 2% because that's their goal, and also the growth of GDP. The two variables clearly that Chairman Powell is dictated by the Federal Reserve Act and Congress that he must look at are the unemployment rate and the rate of inflation. That is what is referred to as the dual mandate. Now, the standard operating procedure of the central bank is if inflation exceeds the dual mandate, you should be above the long-term equilibrium Fed funds rate. If it's if the inflation rate is higher, you want to be in a restrictive mode. Secondly, if the unemployment rate is higher, then you want to be in an easing mode below that long run rate. So, I mean, that is the policy of the Fed. Ask Jay Powell. That's how. Now, there's a weighting factor. Normally, we give equal weight to both of these dual mandates. Now, this is what the Federal Reserve said in June. It believes that under 2% inflation and 4.2% unemployment, the Fed funds rate should be 2.8%. 2.8%. That's sometimes called the neutral Fed funds rate. That's sometimes called R star. That's the funds rate where you're perfectly in balance. You're happy with the labor market. You're happy with that inflation rate. There's no reason to provide any extra stimulus, and there's no reason to provide any pressure above. All right. As a result of the Friday data, we blew past the 4.2% unemployment rate. In other words, after being for years below that rate, which is called a too tight labor market, a market where you want to, slow demand, we went to 4.3%. Now, clearly only 1/10 above, but we went above that. So from that end of the criteria, there should be no more restrictiveness whatsoever. In fact, you could argue that there should be a small amount of ease because you're actually slightly above the target. All right, let's take the other half of the dual mandate. That's inflation. Year over year inflation, core CPI is 2.5%. I guess if you take the CPE, it's 2.6. Now, as you know, I've been, we at Wisdom Tree have been creating indices that use realistic rentals that actually give that rate much lower. But let's even forget all that. I mean, I think that the 2.5% is too high. Let's buy the official data that the Fed is using. Well, at the high, we were having year over year inflation that was 6, 7, 8%. So we have now come down 90% towards our goal, at least 90% towards our goal of 2% inflation. So we've got those dual mandates. On the unemployment side, we've blown past being restrictive into a territory where we should be below the long run. And on the inflation side, we're not quite to where we should be by the official data, but we're 90% there. Now, with those two facts, there's no forecasting here. I'm using data that everybody accepts. Why has the Fed not moved 1 inch, 1 basis point on the Fed funds rate? They've kept it at 5.33. Actually, the rate on reserves at 5.40. When they say if we're at 2% and 4, we should be at 2.8. So we're nearly twice as high as we should be when we're at between 90 and 100% towards our goal. And by the way, that ignores the lag in monetary policy. Chairman Powell himself has said you don't wait until you get to the goal before you finally ease. Well, given that we're 90 to 100% of the goal, why have we not moved at all? I want answers. I think the financial markets deserve answers. What's wrong? Do they not believe their own long-term forecasts? By the way, the 2.8% came up from 2.6%, their long-run goal, in March. So they had raised it 0.2%. Even if they, raise it at the September meeting another 0.2%, you're at 3%. And you're 90 to 100% towards your goal, and you haven't moved an inch. I do not see any logical reason. I mean, this is not rocket science. This is like simple arithmetic of the most basic form that no one talks about. Powell doesn't talk about. I mean, it really was brought home when we blew past one of the mandates from being, restrictive to we should be more below the R star. I said, oh my God, we could argue we're restricted. Now we're 4.3. So the policy makes no sense to me. Now, if you take all the models that weight these two mandates, the most popular one is called the Taylor model, by John Taylor, who was, the Secretary of Treasury, and he was certainly bruited as possibly a Fed chair. He's written one of the most popular textbooks, and he's a real good economist, called the Taylor Rule, where he has gone through and marked what should the Fed funds rate be given these long-run data. Well, the latest I've seen is somewhere between maybe 3 and 3.5%. I actually argue with the data. If you put in the Friday's data, you're probably closer to the 3% number right now. All the other models that I've looked at that use the dual mandate, which Chairman Powell mentions every single meeting, has put the rate between 3 and 4%, maybe the highest. So why are we at 5.4% right now? So I said, listen, we cannot make the same mistake on the way down that we made on the way up. And you know what that mistake is, because as Jeremy mentioned, I was one of the first to call that out, and that was way too slow at raising rates. So I called for, and certainly there's a bit of arbitrariness, 75 basis points now, 75 basis points in September. That gets us to about 4%, which is still on the high side by any of the models that I see. But, clearly, it's so out of the extreme of what people are talking about. I didn't want to say, hey, there's a case to be made to go down 200 basis points tomorrow. So basically, I just do not want to give the Fed a free pass. Jay Powell is just looked at with this reverence that, the Fed knows best. Well, the Fed doesn't always know best. And we certainly saw that 3 years ago on their reaction to the inflationary pressures. And I wanted to add commentary in this mix about, hey, let's be on alert not to make that same mistake on the way down. Now, what are the consequences of staying too high? Well, clearly, the threat of recession. Notice I did not call for a recession. I didn't say a recession is inevitable. There are a lot of models now that, the so-called SOM rule, which is, a rise of the unemployment rate by a certain amount, 3-month moving average, triggers recession, and now is giving 90 to 100% in recession probability. I'm not saying that that's the case. I'm just saying that if the Fed does not move soon, and by far more than 25 basis points in September, the risk of recession will have risen dramatically. I can't give you an exact number. They mentioned, I got over the weekend, Goldman Sachs, it raised it from 15 to 25. I would say, if the Fed is moving 25 basis points in September, you're going to go up to 50. So clearly the R word is rearing its ugly head. Now, we did get a decent service sector ISM after a pretty disastrous manufacturing ISM on Thursday, which certainly is encouraging. But when you look under all the numbers, when you listen to the commentary on the earnings call, you definitely see a slowdown. And when you see a slowdown, down to the normal rate of growth, we're at the equilibrium unemployment rate, I do not understand why we should be 50 basis points over the neutral rate. Austin Goolsbee, I have a lot of respect for him. He's a FOMC member. He's a faculty member at the University of Chicago. He was on later. He was very hedged, but there was no question that he was one of the number that Chairman Powell mentioned during his news conference that wanted a Fed rate cut last week. I am just very disappointed. I think that the voices within the Fed that don't agree with the consensus of the chairman should be registering dissents. As you know, we have now gone, if my data is correct, the longest period of time in history that there's been no dissent from the chairman's position. And one of the reasons there is no dissent from the chairman's position, as I understand it, is the modus operandi of Jay Powell, who goes around to every person, tells them what their decision is, and do they agree with it? And if they voice any objections, I mean, he says, well, if I change this word, tweak this word here in the statement and this word in the statement, would you be able to go along with that? I mean, he's not a confrontational person like, you're being disloyal to the committee, but he changes tiny little words to get unanimity. And obviously, if a chairman comes into your office and okay, I'll be able to vote on that. But let me tell you where I stand. Well, we need more people that are actually voices of that say, listen, we are not moving in the right proportion at the present time. And I wanted to mix it up and give a pretty stark evaluation of the Fed's position and start the discussion of what should be done.
The first question that comes back, you hear this, more than half the commentators, maybe 75, 80% of the people I see commenting say, if they were to make a short-term cut, it reflects panic and the market's going to respond negatively. How do you push back on that?
Okay, so there's two ways on that. There's not empirical evidence that happens. Now, I remember, and I don't know, I think I did mention this on CNBC. I remember sitting on the computer in January of 2000, 2001, excuse me. So the dot-com bubble had burst of 2001. A lot of people wanted the Fed to start lowering interest rates in their December meeting, 2 weeks earlier. And exactly sort of what happened there. They did not. And the data started coming through, and it was much weaker. And there was this big call, oh, my goodness, get a cut. In the middle of the day at 1 p.m., the Fed announced 50 basis point cut in the funds rate. I don't remember the 2 points, but 50 basis point cut in the funds rate. Fed NASDAQ futures, now they had been hit because, the bubble had popped. Within 60 seconds, rose 20%. 20%. It was unbelievable. I mean, obviously there was a lot of, and then it finally, I think NASDAQ was up 10 to 15% on the day. I mean, obviously there were a lot of shorts that were triggered on the way up there, but no one had ever seen that before. So to tell me that it is panic, well, where's that empirical evidence? No. You know what the feeling was? The feeling was, you know what? The Fed gets it. Now, as was pointed out on CNBC, it didn't stop the bear market. We went into a recession, but it was a mild recession. And let me tell you, it would have been a lot worse if the Fed had not responded. But the empirical evidence is when they give a surprise on the downside, it's not, oh my God, the Fed knows something that we don't. Point number two, and this point I made also, so, are we worried the Fed knows something more than the market? Unfortunately, the Fed has not been good at forecasting. Really, few private forecasters can do very much better than the market in terms of foreseeing the inflation. Yes, there's false alarms, et cetera, and so on. But the idea that, next week, what data are they going to get? I mean, I think it's an acknowledgement, all right, we should have gone, this is weak data. When we look at it, we're really far from neutral. I want to tell them how far from neutral we are. All right, I get it. All right, we should be lowering. I think that's a positive response. It's not because they're getting some bad information. They get exactly the same information that we get, except that Chairman Powell gets it about 6 hours earlier than the market. The Bureau of Labor Statistics and the BEA pass him the number, and that's about it. I think there's 3 people that get it slightly early, but they don't get any other data that we don't have.
So, Professor, it's kind of on that same topic, because this is where we're getting a ton of questions. That, this is the feeling of what you think they should be doing, but the questions coming in, what do you think of the odds of it occurring, a cut before September? So do you have faith in Powell and company that they would do such a thing or not?
Well, I don't know how much faith I have. I mean, I'm trying to prompt them to really seriously think about them doing it. I'll tell you, whether they do an intermeeting, it depends on the data that's coming in. If we get jobless claims continue to rise and other weak real data coming through, I think there will be a cut. I think they're just, listen, I think the honeymoon is over for Jay Powell. I mean, he had a year where he was bathing in, the immaculate disinflation. Look at, I landed, I landed perfectly. I stuck the landing, in Olympic terms, perfectly. Oh my God, the honeymoon is suddenly ended. He's going to be getting phone calls from a lot of people. Why aren't you there? Why aren't you starting the process? And, we'll see with the data. What's the probability? So, that would involve me forecasting, and first of all, how strong the data is, and second, what is the tipping point of Powell and company? See, one thing, Powell has a lot of good traits, but one of his traits, which I think is not good, is he's far too deliberate. I mean, he was told early on, don't surprise the markets. And not only does he not surprise them, it's like he takes a meeting to tee them up. That's 6 weeks. Then you tee them up, and then you go 6 weeks later. The economy doesn't wait for that long. And of course, that's one reason he was so terribly late on the raising of interest rates in 2001, 2002. If you really go through history, short-term rates are supposed to be volatile. We have a system now where the Fed sets them and slowly changes them. But when we were on a system where you were targeting the money supply, or you were on a commodity standard in history, you had short rates bouncing all again. Weak news, short rates would go down. It was a long rate that was more stable. Short rates are supposed to be less stable than the long rate. We've gone in exactly reverse. We slow to change the short rate, and it's tail wagging the dog, trying to let the long rate do the problem. Well, look at the inversion now. Now, they pointed out the 10-year didn't invert, but let's take a look at the Fed funds rate 10-year. That's what I always base my inversion on. And the Fed funds rate at 5.33 with the 10-year, now, under 4%, 3.8 in the morning, and who knows how much lower. What are we getting? 180 basis. We should be moving the short rate below the long rate. That's the normal configuration. Now, I understand when you're pushing against inflation and too hot a labor market, okay, you invert. But we're not there now. So why continue it? In fact, worsen it as a result. That's my statement right here. And I just wanted to add discussion. And I want Powell and company now to explain the simple data I said. One we've overshot, the other we've made 90%. How come we've gone zero, therefore, towards the target? Or in the world of Goolsbee, Austin Goolsbee, even tighter, because as inflation comes down, a given nominal rate means a rising real rate. So in essence, as we're almost hit our goal, we've been making the monetary policy tighter and tighter. That makes no sense to me. And I don't know to whom it makes sense. I want these questions should be on the table to the Fed, hard questions, and they got to rethink one or the other thing, but they are not doing what they say they're doing. And September, as you know, is a quarterly meeting where we're going to get a new set of projections long term. And the policy and the projections are making no sense when put together. So it's like a rudderless Fed with it's only like, how much are we going to, those people talking about whether we're 25 or 50 basis points in September, I mean, it's almost like you're in the wrong universe there. It's a question. We're so far away from the neutral that's taking a little pail of sand, trying to empty the beach. It's just not sufficient. Either that, or you're not telling us really what your goals and your policies and your projections really are.
We're getting so
clearly
many
not
questions
in the FOMC minutes that are released every quarter.
It feels like we're going to be doing this call more than once because we are getting an influx of questions. We didn't schedule a lot of time for today. But Professor, if you're just on following Kevin's line of questioning, if they don't follow your advice, you think that's a bigger risk, more defensive positioning. How do you?
Yeah,
think?
And by the way, what kind of stock? I mean, obviously recession risk. This is really, I know dividend-paying stocks have not done well. They're value stocks generally. But if rates are coming down, those could be the type of stocks that really do come in favor at that, and really cushion your downward movement if you're in a disinflationary recession. I do want to mention one thing. I know we got 2 minutes. We were on a couple of calls over last week, and people were asking, is the correlation switched on the bond and stocks? Now, I was answering a long-term question. I said, not really. I mean, that inflation threat is still there. But let me say, in the short run, yes, bonds are a negative beta asset for this type of risk. You're getting diversification. It's just that, with inflation risk being a long-term issue, that'll keep the rate from going down to, 50, 100 basis points on the long bond the way it did, before the pandemic. So, it is. There's no question that bonds are, and I think dividend-paying stocks are also going to be cushions on non-dividend, and of course, non-dividend-paying stocks and the growth stocks, because the latter because of the PE, and the non-dividend-paying stocks about what is the earnings going to be. Perhaps have more to fall looking forward.
Having closing thoughts or questions from you?
Yeah, I was just, just go back real quickly to when we were talking post FOMC. That seems like about 5 years ago, Professor.
5 days
at this stage, right?
It seems like go back to that Wednesday statement, and it's like, okay, we're in a what world are you in now? We're in a different world now. I mean, especially as I say, when the labor market blows past the target, when that unemployment rate went when no one predicted it to 4.39, I know it rounded up. It was like 4.27 or whatever it is, but it rounded above the target. I began to say, now just a minute here. You're above the target on what you want unemployment to be. You're 90% towards the target on inflation. Why have you not moved? It's as simple as that. I think the American people, stockholders, should demand an answer to that question from the Fed.
Well, and just real quick, as I was saying, after the Fed meeting, for us, the fundamentals, in a sense, haven't changed. So, the barbell strategy that we were talking about, our own investment committee meetings is something we're still emphasizing and adhering to going forward, anchoring it with Treasury floating rate notes, core duration on the other side of the barbell. So that's our positioning, and it's been working out very well. And you don't need to make an explicit type of call. You have some flexibility in the front end. You can participate in rallies in the core part of the curve. So from the bond side, for us, it's still all systems go on the barbell. So, Jer, any final thoughts on you for quality or anything like that?
Yeah, I think I maybe on a follow-up call, there's probably about 30 questions that came in on the yen carry trade. So there's a lot of people, Professor, who want to know about the Fed lowering rates. I mean, if there's been a market that's volatile, Japan has had, overnight, a huge move. We have some model portfolios that are sort of tactical. Today, we actually added 2 positions in our Japan strategy because of that sell-off. We think a bit of it's overdone. You never can time the bottom on these sell-offs. But for people who are questioning, is it changing our thesis? For me, it has not. We think 10 PEs, 11 PEs, good value versus the S&P. You still get 3 to 4% carry if they do start following the professor's advice. But we could go into a whole call on that at some point in time. But any quick comments on that from you?
No, I mean, the magic words 10, 11, 12 PE, and I think it was a real overreaction with the carry trade suddenly. Don't forget, trending markets and foreign exchange, the real trending markets, are subject to sharp reversals. Momentum players get on. They have their, stops placed real close, and as soon as it breaks, they all sell at once. I mean, and that's often the time. I don't think this sell-off, people say, oh, wasn't that this morning and it's going to bounce back? No, because fundamentals have changed. The fundamentals have weakened dramatically with the Fed so very high and the market not selling at 10, 11, 12 PE ratios.
Professor, it's always great to get your comments on a day like this. I'm sure we're going to be doing it again soon. So everybody stay tuned to your emails. Thanks so much for dialing in, everybody. And Professor, thanks always for your very insightful insights. We got a few people saying they need to put you for Fed chair. So we'll second that comment on our close. Thank you so much for dialing in.
Thank you very much. We'll see you again.
Thanks everybody.